What up, beautiful people? You are watching my free crash course with Take Profit Addicts. This your boy Leo, 10-year veteran. But before I get started, I gotta talk about something. See, a lot of these Forex gurus and these trading gurus gonna be mad at me, but I don't care. Somebody gotta say something. Forex wasn't always like this. Like when I first started 10 years ago, you didn't have a bunch of traders creating a course scamming people, acting like they know what they're talking about. You didn't have a bunch of traders running Facebook and Instagram ads. You didn't have a bunch of traders with YouTube videos. That's how I was able to blow up, because it was very few people. When 2023 came around, I took a break. All 2023, I just been trading. This is one of my first videos in 2023, okay? Like I'm back on the scene. But I took a break because I got away from all that noise, all that chaos, all that drama. So I was just trading, right? Let's rewind a little bit. Like back in 2015, when I started teaching people how to trade, I had only like 15, 25 people in my Facebook group. My students started making money, so I was proud of that. So I started putting videos on YouTube, live trades, withdrawal proof, and a lot of student testimony. See, my first video was 6 years ago. That's all that's on this channel. Now, if you look at a lot of these trading gurus and you go to their videos, go to the history tab, and see what they were doing before Forex, many of them were marketers. And in my opinion, my honest opinion, these are the people that ruined Forex for a lot of people. You know, marketers can promote anything. They're trying to sign people up and make that little money and take care of their family. I know how it goes, so they'll lie, they'll cheat, they'll steal. Many marketers are like that. And I think that's how most people got introduced to Forex, by these marketers. Some of the worst people in the world, because they bought their money. You dig? And how I know? Because I've been marketing on internet forever. Since 1999, they had AOL dial-ups back then. Nobody taught me anything. I edit my own videos, I do SEO, I design my own websites, I generate my own traffic. I learned everything without all the hype and the scams, you dig? But when social media came around, everybody tried to be gurus. Let me tell you something about these marketers. They are taught to position yourself to be a figure of authority. Sound like you know what you're talking about. So they're able to sell and promote anything. And I've been doing YouTube for a long time. And one thing I noticed when I was in the marketing game, people used to call the companies I was promoting a scam. I used to see people coming for me back in the day, and I was like, wow. But I noticed a pattern. They all had videos about the company that they wanted you to sign up with. See, they were trying to ride my wave to make money off what they was promoting. And that's how the whole YouTube game worked. So you can't even trust the people that's calling people scammers. Feel what I'm saying? Listen, everybody not broke. A lot of people got lawsuit money, inheritance money, money they saved. It's nothing for somebody to put $10,000 in a trading account and come back around and make a video of them withdrawing that same $10,000 and convince you that it's from trading. They just withdrew the money they deposit. Listen, I can make a video, and I might do this. I can make a video and show you how they manipulate these charts like they're making profits with a real chart, and that's a demo account. I can really do that. I can show you many things these traders are doing to manipulate people. But they have a big following, they grew their following, so the outsiders are looking like, ooh, he's a good guru. He got a big following. Let me rock with him. All the while it's part of their scheme to scam people. So with my experience, I'm going to speak out on that. Not only that, with my experience, I'm going to drop this free crash course to get you on the right track without all the BS. You don't have to pay for this course, it's free. Like I said, I don't post material stuff to brag, but I do own a few things. Take vacation, jet skis, yachts, all that. I do that. I just don't post that on social media, okay? But you're definitely in the right place if you want to learn the truth about Forex without all the BS. So we're going to get into it. I even got students that used to hit me up, like old students, because I told you I stopped trading in, well, I ain't stopped trading, I stopped teaching in 2023. Let me say that. I stopped teaching in 2023. Just took a break. A lot of people been hitting me up. Okay, thank you for putting me on Hanko Trade. The 1-day withdrawal process to your account compared to 3 days is crazy to me. I'm gonna withdraw some money and throw it in my boss' face when I quit. I'm doing a podcast with Funded Trader Prop Firm. They do numbers. I wanted to shout out your course. Make sure you was cool with that. I said, yeah, I'm cool. Now, before the prop firm started not paying people and all that, he was with a prop firm that paid him $50,000, gave him a funded account $50,000. So I saw the funded account, so I knew he was official. So then he hit me back and told me he wanted to shout out my course. He was rocking with me for a long time. This is one of my day ones. Hi, Boss Leo. I'm the OG in the Pip Society. I am in the Discord, but for some reason the Discord group vanished from my PC. Did you shut down the program? You the GOAT, bruh. You gave me the fucking keys. I just passed the phase 2. A bitch is funded. I'm going to send my certificate once they send it. Thank you, thank you, thank you. Horse. A lot of those messages are from my students. I can show you I got hundreds and hundreds and hundreds of, probably thousands of messages from students. One of them, if I'm gonna bring the program back out, one of them I'm gonna start teaching people again, do one-on-ones or whatever. So those are the kind of messages I get all day. Like I say, I'm 10 years deep in this game. I'm very low key. I don't care about social media. I don't care about bragging. But somebody gotta say something about what's going on. It's a lot of fraud stuff going on. I don't trust too many traders out there. There's about 2 or 3 traders, to be honest with you, that I trust, that I know get into their bag. And that's sad when you see hundreds and hundreds of traders out here manipulating people. With that being said, we're going to get into this free course, crash course. So if you have any questions, you definitely can hit me up. Leave a comment. You can follow me on IG. I'm going to leave my link up here. I'm going to leave my on Facebook link in the description box below. If you got any questions, y'all can hit me up. Because a lot of time on IG and on Facebook, I post signals, free trade alerts in my stories, help people out, Let's get to it, man. Yo, this video is for anybody that want to learn how to trade Forex or stock options without the BS. That's what this channel is about. This is my new channel. Now, I do have a history. I've been trading for like 10 years. So in the beginning, I'm going to break down some stuff. But be patient and go through the entire video and you won't regret it. Let's get to it. What is the Forex market? The Forex market is the largest financial market in the world. It's larger than the stock market, equities, and future combined. The Forex is doing $6 trillion a day now. This image is old. That's why you see 5.3. It is up to $6 trillion a day. Who trade the Forex market? Well, you have the super banks, central banks, governments, companies, and retail traders like you and I. We are against all these big dogs up here, so you can't beat them. You only can trade in line with them. Do not try to outsmart the market. It will not happen for you. Forex market hours. The London session opens at 3 a.m. and closes at 12 p.m. The New York session opens at 8 a.m. and closes at 5 p.m. All this is Eastern Standard Time. So the best time to trade is when the London market and the New York market overlap. That's at 8 a.m. Eastern to 12 p.m. Eastern, okay? Now at 5 p.m. Eastern, the new day starts for Forex. You have the Sydney session. It opens at 5 p.m. to 2 a.m. Then you have the Tokyo market that opens at 7 p.m. to 4 p.m. Now, I don't really trade late, but if I do, I'm trading the Tokyo session around 8 and 9 o'clock. And I'm trading only the JPY pairs, like the USD JPY or the British Pound JPY or the Aussie JPY. That's it. Now, in the London and New York session that overlap, most people trade the Euro USD. That's the most popular pair to trade, okay? The London market opened at 3 a.m. to 12 p.m. A lot of people wake up at 3 a.m. in the morning to trade the London market. See, the London market and the New York market are the 2 biggest markets in Forex. Major pairs is any pair with the USD. Remember, the dollar is the world reserve currency. So any pair with the USD is the major pairs. Any pairs without the USD are called cross pairs. Now, what is a pip? See, we trade to collect pips. You collect pips or you can lose pips. So you need to know what a pip is. Okay, so when you're looking at Euro USD, when you're looking at any pair without the JPY, the pip is the 4th number to the right of the decimal. Right here, you have the decimal, 1, 2, 3, 4. So 5 is a pip. When you're looking at JPY pairs, the pip is the second number to the right of the decimal. You have the decimal, you have 1, 2. So 5 is the pip, right? So when you're looking at these pips, like you have 2271, 2272, the market just went up 1 pip. You see that, huh? Because this 1 is a 2 now. So you collect 1 pip. And you place the buy, you knew the market was gonna go up, so you placed the buy. The market went up to 72, so you got 1 pip. Now, if you place a buy and the market go down to 0, from 1 to 0, you lose a pip, okay? So you wanna place a sell, so when it go down from 1 to 0, you still collect the pip. The market can move 50 pips a day, or 50 pips in 15, 30 minutes. The market just move, okay? So understand that. Now, the first currency is the base currency. The second currency is the counter currency. You see the market has 1037 to 1039, that's a 2 pip gap. So what is this 2 pip gap? That's the spread. So if you were to take this trade, you will be down by 2 pips. You're always going to start off in the negative. So if your pip costs $10 a pip and you're down 2 pip, you're going to be negative $20 when this trade start off. That means you got to move 2 pips for you to break even. This is very important. You must look at the spread when you start trading, because sometimes these spreads be like 20 pips, especially when the market just open or they know some news going to come out. So the pips fluctuate. So you got to pay attention to the spread. Now, when you start trading, you want to find your edge. You want to learn candlestick patterns for technical analysis. You want to learn price action. And you want to learn fundamental analysis. That's like with the news and stuff like that, okay? You must find your edge. Find a way to have the advantage when you're trading the market. It's true, you can't predict the market, but you can find setups, patterns, and strategies that give you the edge. Then you need to find a broker to access the market. You have regulated brokers and unregulated brokers. Regulated brokers are in the United States. They're only going to give you a 50 to 1 leverage. Unregulated brokers will give you 500 to 1 leverage. And that's what most traders want. That's why a lot of traders use unregulated brokers. Just because a broker is unregulated, it doesn't mean they're scammers or they're screwing people. You just have to find the right brokers. Now, it's best you have a regulated broker, so if something happens, you can get your money back because they're regulated. But with an unregulated broker, you're not going to get your money back if they want to screw you, okay? And the best thing to do is ask around people you know that trade, ask them what broker they use, how they feel about the broker. Do your due diligence, okay? Or you can look in the description box and look at the broker I rock with and sign up with them. That's a great broker to have, okay? Many people use those brokers, and they do pay out. As a trader, you want to use a risk to reward ratio. This is very important. This is important as any strategy you use. You have to have a risk to reward ratio. I use a 3 to 1 risk to reward ratio, or 4, 5, 6 to 1 risk to reward ratio. Basically, what that means is I'm risking $1 to make $3. So that means when I'm wrong, I'm losing $1, and when I'm right, I'm making $3. Let me break this down. So my risk in a trade, let's say I'm risking $100 to make $300. That's still a 3 to 1 risk to reward ratio. So if I lose my first 3 trades, let's say I lose trade number 1, I lose trade number 2, and I lose trade number 3. I'm negative $300. I'm in the hole, $300. Then I win my first trade. I win $300. I already made my money back, so I'm back to break even. I win my second trade. I'm $300 up. I win my third trade, I'm $600 in profit. See, when I win, it's recouping my losses. So I'm staying ahead of the game by using the 3 to 1 risk to reward ratio. This is very important. Winning 50% of 10 trades. If I lose 50% of my trades, I lost $500. Now, if I just win 20% of my trades with a 3 to 1 risk to reward ratio, I made $600. So really, I'm up $100 now just by winning 2 trades. This is the power of risk to reward ratio, a 3 to 1 or more, because you're gonna lose trades. I don't care who you are. As a trader, you're gonna lose trades. One problem people have when they think about trading, they want to become a trader, they think about the wins, how much money they can make. They never think about the possible losses, which will happen, okay? This is why 3-to-1 risk to reward ratio is very important. The trend is your friend until the trend ends. You want to trade with the trend. If the market is going up, you want to look for buy signals. If the market is going down, you want to look for sell signals. Do I counter trade? Yes, I counter trade, but very rarely do I counter trade. So I find my trend on a higher time frame, then I drop to a lower time frame to look for my entries, okay? This is very important. The trend is your friend until the trend ends. Discipline and patience. You have to have discipline and patience to become a trader. What I mean by discipline, you have to think. You're in the Forex market, paying attention. You want to do the right things. You don't want to take these trades to screenshot and post on IG. I call them IG traders, social media traders, people who do it for the gram. I'm doing this for myself. I'm doing this for my family. I don't care if the internet know what I'm doing or how much I'm making. I'm doing it for me. Very disciplined and I'm focused. I write down my rules. I'm only taking this type of trade. When I see that on the chart, everything add up, then I'm in there. If the trade don't match my rules, I'm not taking the trade. That is discipline. And be patient. You got to be patient. Because some traders will see a trade, they know the market's supposed to go up. 15 minutes later, the market not going up, it's consolidating or ranging. And you say to yourself, man, I'm tired of looking at this trade. I know the market gonna go up, so let me just hop in. And they hop in, they get in the trade too early. It's called FOMO, fear of missing out. You get in that trade, the market go against you a little bit. Depending on your position size, you get stopped out or you blow your account because you wasn't patient for that trade to play out. You wasn't patient enough to wait for that signal. Discipline and patience is very important, people. You want to write down your rules. You only want to trade your rules, okay? And you want to be patient and wait for your setup to match your rules. Discipline and patience. Understanding market structure like a pro. Market structure is one of the first things you learn when it comes to trading. Probably the first thing you learn because it's the foundation of trading, okay? So let's get into it. There are 3 types of trends: an uptrend, a downtrend, and a sideways trend. Some people call it ranging or consolidation. This is the least way people choose to trade. Some people do though, but you're going to have to put more money in. So you're putting a bigger risk on trades like this. I want these uptrends, these bigger moves, or the downtrend, a bigger move. So understanding market structure, you'll understand higher highs and higher lows, and lower highs and lower lows, okay? So when you're in an uptrend, you're going to see the market create a low, a high, a higher low, a higher high, a higher low, higher high, and a higher low. This is a higher high because this high is higher than the previous high. This is a higher low because this low is higher than the previous low. So when the market creating higher highs and higher lows is on the uptrend, then you might have a sideways trend. There's nothing going on right here. Equal highs and equal lows. So when you create this equal high, what it do? It breaks structure. This is support area. It come down and create a lower low. Now you're looking at a possible reversal. It's not a reversal until it created a lower high. It created the lower low already. Now you won't see that lower high because this high is lower than this high right here. So now we got a reversal. It's a break of structure. The market go down again, create a lower low, and a lower high, and a lower low, and so on and so on. This is how the market moves. This is a textbook example, but I'm gonna show you on chart how the market move for real. It's not this pretty, okay? It's not this pretty every time. So keep that in mind. Now, multiple time frame analysis. When you're doing your analysis, looking at higher highs and higher lows, you got to make sure you pay attention to multiple time frames. The 4-hour time frame, the 1-hour time frame, the 15-minute time frame, the 5-minute time frame. Because look what happened. The market create a higher high, it create a higher low, it create a higher high. So the market seems to be on the uptrend. Most traders don't understand multiple time frame analysis, so they end up getting in at the high right here when they should have got in at the bottom and ruled it up. So if you get in right here, they're going to give you that drawdown. Now you're in the negative. depending on your position size, it could be a huge negative. You get scared, you're checking out the trade. Why is this important right here? Because this downtrend on the 4-hour chart right here, it's all of this on the 1-hour chart. So you're in a major negative and your stop loss probably get hit. You want to get in on the dip. If it's on the uptrend, you wait till it come down and get in right here, and then you ride that thing back up for profits, okay? But we're going to get into all of this. I got you. The anatomy of a candlestick. A green candlestick represents a bullish candle. That's an uptrend candle. The red candlestick represents a bearish candle. That's a downtrend candle, okay? Right here is a wick. It's the lowest this candle been. Here's a wick. It's the highest this candle been. What happened is, it was this high, but the sellers pushed it down to right here, then it closed. Because on the green candle, it opened at the bottom, it closed at the top. Now, depending on what time frame you're on, for example, if this is a 5-minute candle, it's going to open for 5 minutes and close. And then a new candle form. It open right here next to this candle. Right here at the top where it closed, a new candle form. It open right here. It probably go up and close at the top, right? Then it keep going on that uptrend. But a bearish candle, they open at the top and close at the bottom. You're on the hour chart or 5-minute chart, it'll open up right here at the top, go down and close, and it's on the downtrend. So this is how the candle works. In the middle of the candle is called the body, okay? The body of the candle. That's candle anatomy, candlestick anatomy. Now, resistance and support. This is a very important level to understand. A lot of people trade resistance and support levels and make pretty good money, okay? The first thing you need to understand about resistance and support is resistance is the ceiling. Think if you jump up to the ceiling and hit your head, you're probably going to come back down, okay? And think of support as the floor. If you bounce a ball on the floor, it's going to come up. That's resistance and support. How you can tell if these are some strong levels. You want to see multiple touches. I'm talking about like 2 or 3 touches. Like 1, 2, 3 touches. So if it touched for the 4th time, it's probably going to go up. This is a strong level. So they buy at the support level and it goes up and they make a profit. Or they buy at resistance and or they sell at resistance and they come down and they make a profit, okay? Support and resistance. These levels can be broken. For example, it bounced off support, went up. Bounced off resistance and went down. Bounced off support, went up. Bounced off resistance and came down. Now look what it do. It break resistance. It bounced up and break resistance. And what happened? Resistance now becomes support. So it come back and test support, go up and create a new resistance, bounce down, create a new resistance, bounce down to support, and it breaks resistance and keep going up. So these levels can be broken, okay? That's why you want to make sure these are some strong levels that you're trading. Trend lines. We draw trend lines in line connecting to at least 2 price pivot points. So you start right here, point A, point B, and then you just drag it out, okay? Point A to point B and drag it out. Trend lines are dynamic support and resistance levels. We extend trend lines further down to include the new price action, okay? So as the market go down, you're gonna draw these trend lines straight from point A to B and just draw it straight down. From point A to B and just draw it straight down, okay? As price move lower to your trend line, you may need to make some adjustments, okay? So this is like a resistance, okay? This is top of the market. So you have resistance trend line up here, and you have support trend lines up here. Look at the touches. 1, 2, 3. That's a strong support area. 1, 2, 3. That's a strong support area. Now, it's not a price point. These areas are like zones. Cause see this right here? It broke support and came back in. It's a zone. You might see some people draw boxes around these zones, or they'll just draw a straight line. That's trend lines. Now, when you see the market hit resistance or support level, you just don't want to take that trade. You want a candlestick pattern. You want to look for something that's telling you the market is reversing. It's reversing. Okay? And right here at resistance, we have what is called a pinball. The market came up, When you see the exhaustion, the seller's pushing it down and it closed like that. That's a sign that the market is reversing, especially on a higher time frame like a 1 hour, 4 hour, or a day chart. The market gonna be going down, and that's what it did. It come to support. You have another exhaustion. Give us a pin bar, bearish pin bar, okay? It's letting us know that the market came down, the buyers pushed it up and it closed like that. That's a sign of a reversal. Take that trade. You don't just want to trade resistance and support levels. You want to follow candlestick patterns. You want to see candlestick patterns at these levels. Like right here, it broke, but it didn't close below support. See, like right here, you see how this wick right here, it broke past support. That's okay. Long as it didn't close, the support level is still holding. So it broke past support with the wick. It came up and closed right above support. When you see stuff like this, it's a sign of a reversal. You might want to place that buy and ride that thing up. Don't just trade support and resistance is what I'm saying. You want to see important candlestick patterns right at these levels. And we're going to get into all of this. Now we're going to talk about candlestick patterns. Okay, we have a bearish pin bar. We were just looking at this on the support chart. The market is strong, it's going up. It closed, it created another candlestick. It was up this high, the seller pushed it down. It closed, then when you see this bearish candlestick close, then you got this bearish candlestick. That's a sign of a reversal. So you might want to sell. But this candlestick right here is the strongest single candlestick in the game, the bearish pin bar. This candlestick alone can do some damage. It can give you a major signal to take a trade during a reversal. Okay, this is a bullish pin bar. The market is going down, then it closed, it opened up another candle, it was this far down, but the buyers pushed it up and it closed. Then what happened? You see this long bullish candlestick for the reversal. Take that trade and ride it up. This is a bullish and bearish pin bar. Now you have a bullish flag, okay? You see this pole, and then you see this flag, and then it break out, okay? That's a bullish flag. And you have a bearish flag. It's going down, it create the pole, okay? Then it create the flag, and boom, you got the breakout. The market went down, okay? Now this is very important. See how this candlestick, see when it broke the market, and the candle came back and retest this level? You want to see those retests. Never just take a trade. Wait for the retest like it did right here, and then it dropped. The retest will save you a lot of money. It'll help you confirm that if the market is going down. Right here, it broke out. That's a retest. One candlestick right here. And it went up, boom, and it kept going up. But wait for those retests, okay? You want to see stuff like this at support and resistance level, but you also want to see the retest. Every time you have a breakout trade, wait for that retest, okay? That's important. Now we have a head and shoulder pattern. You have a shoulder, you have a head, and you have a shoulder. And you have the neckline right here, okay? When the market break this neckline, it's going to continue that bearish trend. Because it was going on an uptrend. It turned around right here. But you don't trade when it turn around here. You wait for it to break that neckline. When it break that neckline, you want to wait for that retest. When it retests, you sell that thing and you're in profit, okay? This is a bearish head and shoulder pattern. Here's another example. You have your left shoulder, you have your head, you have your right shoulder. The neckline is diagonal. This is really a support level too, you dig? So when the market break the neckline, you're in business. You want to wait for that retest though. Make sure it come back and retest this neckline before it drop. And you're in profit. It's an inverse head and shoulder pattern. You have the left shoulder, the head, the right shoulder. The market come up, break the neckline. In this diagram, it gave us the retest. It came back and retest, and then it shot up. You got to be patient and wait for the retest. Now, sometimes the retest don't happen. It might break this neckline and keep going. That's okay. I'm comfortable with missing out on trades because I got other opportunities in the future, okay? But retesting ensures me that I'm taking the right trade. It's called a retest or a pullback. Now we have a double bottom. It looks like a W, okay? And you see it break this neckline right here. It goes up, it come back for the retest, and then it shoot up. You take that trade after the retest. Stop loss will be right around here somewhere, okay? We're gonna talk about setting your stop loss and everything in the future. Right here's a double bottom. It's the opposite. It shapes like an M. It shapes like an M. It break the neckline. You want to wait for that retest, and then it drop. Now, doji candlestick. These candlesticks represents indecisiveness, okay? You normally see these around upcoming news and the market is not moving. Why is the market not moving? Because the investors are indecisive right now until the news come out. You see, you open at the bottom, close at the top, okay? Small little body right here. Open at the top, close at the bottom. Small little body right here. You have long wicks. The market go up, go down, come back up and close right here. The bearish candlestick, the market go up, go down, close very small body. That's because the market is indecisive. Like I said, this will happen normally around upcoming news. Okay? A rising wedge. You see this wedge right here? The market is trading between, it's getting thinner and thinner. It need to breathe. It need rooms to breathe so it break out. It come down and break out. But what I'm waiting for? A retest, okay? And then the continuation. Now, this market, this pattern right here, the rising wedge, it can break down or it can break above, okay? So remember that. It can break above or down. And last but not least, this is my favorite candlestick pattern. The bullish engulfing, the bullish or the bearish engulfing candle. Like if I see this on the day chart, I'll probably be trying to look for a buy, okay? This candle is engulfing this candle right here. That's a bullish engulfing candle. On the day chart, this is a strong setup. So what I do, I drop to the 4-hour chart or the 1-hour chart and I look for buy signals. I'm looking for something to tell me take that buy because it's an engulfing candle on the day chart. If you don't remember anything in this training, remember this. Look to the left. Structure, leave clues. Look to the left. Structure, leave clues. When you're on your chart, look to the left. The structure of the market will leave you clues what the market might do next. The market is not perfect. It's not going to always play out the way you want it to play out or think it's going to play out, but it does help. So look to the left. Structure, leave clues. Okay, what up, world? Right here I'm looking at 147.82.6. This is USD, Japanese yen. I see the supply zone. I also see this 78.6 level, okay? That's my target. We're gonna see what it do. So let me show you. I already got this order in on my MetaTrader. But we're gonna see what it do. Look at my stop loss. My take profit is like a 3-to-1 risk to reward ratio. Playing with about 6,000 in this 6,500 in this account. See if we make some money today, you dig?
One of these days you get me and you'll be so sorry.
Looking good.
Yeah, coordinated.
Which parts?
Right boot with left boot.
How did I miss that? How goes the wild work?
Just got back from patrolling the Highlands. Black and Bench are shrinking. My saloons are already heading south.
Well, means we can have a nice warm spring.
Tell me you don't miss it.
The stench of sulfur and the frostbite. Now, being a warden suits you a lot better than it ever did me.
Guys, as you can see, my entry got hit perfect. My stop loss didn't get touched right here, and we currently in profit. I'll break this trade down for y'all in a minute. PT profit just got hit. I'm at 620. Y'all probably heard my TV in the background. I just set this up, got back in my bed and finished watching TV, came back to my computer and saw it play out. This is how I trade every morning. Candlesticks and price action. Price action trading is the study of price history. It's the discipline of making a trading decision from a clean price action chart with no indicators, strictly price. This is what I call a healthy candle. This blue candle right here, you have a flat top and a flat bottom. You see this flat bottom? No wick. You got a little wick at the top. I couldn't really find a flat top, but this candle will do. This is a healthy candle, but you want to see a flat bottom and a flat top. When you see a strong candle like this, plus it's long, okay? So you got a long, healthy candle. It's a bullish candle. What happened next? This is the bullish candle right here, the same candle. The market went up. Went up, okay? You have bearish candles and bullish candles. So these are some of the things you need to look for when you're watching these candles, because you must pay attention to the individual candle as well as group of candles, because they tell you a story. Now let's talk about trends. This is a strong uptrend. It's strong. See how I just go straight up? This is an uptrend too, but it's gradually going up. This trend is stronger than this trend. And this is a bearish trend, a downtrend. Look how strong it is, straight down, okay? So that's how you know if the trend is on a strong trend or a weak trend, okay? These are the things you must pay attention to. And beware, you don't want to trade at the end of the trend. See, this market been going up for a couple of weeks. I think this is a daily chart. Market been going up for a couple of weeks. If you would have got in right here because it broke this level, you would have caught the reversal. It would have went against you. Okay, so pay attention. Where are you getting at where are you getting in the trend? The beginning, the middle, or the end of the trend? Possible end of the trend. Now, I'm looking at a downtrend. You see, I see the trend is down. It's strong. It's doing what it's supposed to do. It's going down. First thing I want to do, find the overall trend on the higher time frame. How strong is the trend? Look for a signal based on the trend. The trend is your friend. But since I'm looking at a downtrend, I want to look for a signal that tells me to sell. So I'm looking at this trend, and what do I see? I see a head and shoulder pattern. Left shoulder, head, right shoulder. Okay? So if the market break this neckline right here, come back and retest, that's a sell signal for me. I'm going to take that trade. So let's see what happens. So the market break the neckline. Now what I want to do is look for a signal on a smaller time frame, just like a 4-hour or a day chart, something like that. I'm going to drop to like the 5-minute chart and watch the market come up here and test this level and then drop down. So now I'm on the 5-minute chart. So the market come up right here. I get in, place my stop loss about right here. Place my stop loss above this resistance and really above this low right here to be safe. Place my take profit right here. Okay. On the 5-minute chart, I'm on a smaller time frame. I'm using a 3-to-1 risk to reward ratio. So what the market do? It come down, come up, and then eventually hit my take profit. And I'm out of the trade. I'm done. So keep that in mind. You want to look for your trend on the higher time frame, strong trend. Then you want to drop down to the lower time frame. Look for your signal entry, and then you set your 3-to-1 risk to reward ratio and ride it out. That's what you do as a trader. And as you can see on the higher time frame, this is how it look. Came back and retest, and you roll that thing down, you made your money. It's that simple. You don't always have to wait for the retest, because every setup not gonna give you a retest. I wait for the retest because I'd rather miss out on the trade than to lose money. If I would have waited for the retest and it never happened, so be it. I got other opportunities. tomorrow and the next day and the next day. The 50 EMA magnet. Well, this is the 50 EMA. Pay attention to how the market come up and they come back to the EMA. That's what he loves to do. The market come down, come back up to the EMA. Come up a little, come down, come back to the EMA. Go up, come back to the EMA. Come down, go back to the EMA. So if the market is pulling away, you just got to make a guesstimation on when the market gonna stop and retrace back to the EMA. Right here, it goes up, pull away, all the way up here, come back to the EMA. These are some tips and some things you need to know. Impulsive move and corrections. This is an impulsive move. This is an impulsive move from here to here. This is the correction. A correction is a temporary reversal. Okay? You got impulsive move, correction. Impulsive move, correction. Okay? So, this is what you measure with your Fibonacci tool to find entries and exits. What do I mean? Okay, so we got an impulsive move from here to here. So I'm gonna draw my field from here to here. Where do it come back to? The 78.6. 78.6, the 61.8, the 50%. These are all key levels on the field. The 38 too, but I don't use the 38. The 50, the 61, and the 78% are the three levels I trade from. And sometimes the 88% too, you dig? But if you go to 100%, you're on the wrong side to trade. The market's probably reversing on you. I use the 100% as my stop loss. Okay? So we got the impulsive move, we draw our field. Now if the market is on the uptrend, we draw our field from the low to the high of the impulsive move. If it's on the downtrend, we draw it from the top to the bottom of the impulsive move. That's how you draw your field. In this case, we on the uptrend. So from the low to the high, most recent high. The market come down, and this is probably a trade I would have took at the 78.6. And look at the catch. Could have caught all of this right here if you knew what you was doing. But there's much more to talk about when it comes to fibs and supply and demand levels. Most of that stuff is in my course. I don't really put that stuff out here, but I'm gonna give y'all some sauce though. Another setup I like, the daily pin bar right here. This is a daily chart. If the day closes and I see this pin bar, I know what I'm doing tomorrow. I'm selling. Look what happened on the smaller time frame. I caught all of this. This is about 120 pip move. I caught this. All because of that daily pin bar. Now, one of my favorite setups, engulfing candle. This is a daily engulfing candle. This candle is engulfing this candle right here. And I highlighted this because I wanted to see how much you could have made getting in at the top on the next candle. So if I go to a smaller time frame, you see the market moved up. It's like 121 pips. But I should have moved this up something. So it's probably like 100 pips. Still great. 100 pip move. Go for a nice, simple engulfing candle on a daily chart. It's gonna take time. If you just practice, you're gonna get it. It might take you a week, might take you a month. But if you study price action, be patient and wait for these setups to happen, you're gonna make money. Stop falling for these videos. They're talking about, I can show you how to make $10,000 a week or whatever. The knowledge is in you. You got the knowledge. I just gave you some of it. Start there, just practice and practice. Because if you pay for somebody's course after watching this video, you're gonna be like, wow, Leo gave me the same information for free. So I'm telling you, be patient and practice what I'm telling you, and you're gonna be alright. That is the way to trade. And even if they are good gurus, they teach you the same thing. A lot of these gurus are teaching the same thing. They're ripping courses from other courses and putting together their own package, but it's all the same thing. I'm giving y'all some knowledge right now. Like I say, slow down. I know times are hard for most people. A lot of people trying to find a way to make some extra money, but slow down because you're running into a brick wall. People are robbing you. And if this information been helpful in any kind of way, do your boy a favor and hit that like button and hit that bell notification. Help the channel grow. Hit that like button, and I'll see y'all soon. Peace.